my pleasure to introduce to you Professor M. Jayadev. He is the chair of the Finance and Accounting area at IIM Bangalore. He sits on the board of many banks and is a highly regarded banking expert.
Thank you. Hello. Welcome to Platform for Investor Education. In this series, we are discussing about what are NPAs of banks. The primary function of banks is the mobilization of savings from the public and transforming them as loans to individuals, business firms, and industry at large. This is called as intermediation process. This poses a major risk to banks, namely that borrowers might fail to repay these loans. These loan defaults are called non-performing assets or non-performing loans of the banks. There are many reasons that affect the debt servicing ability of firms. Unpredictable business and economic factors. It may be economic downturn, fall in commodity prices, liberal import policies, rise in production cost and subsequent fall in cash flows. And apart from, businesses may also adopt imprudent practices, obsession for extraordinary growth by building excessive capacity, acquiring firms through over-leveraging with variety of innovative debt instruments, complex corporate structures, strong interlinkages between the associate and joint venture company. Some portion of NPAs are unpreventable and it can be acceptable as a business risk for banks. But an increasing trend in NPAs is worrisome, can lead to banks' ability to pay the deposits, and it may lead to systemic failure of the financial system. Many countries, for example Japan, have experienced such crises from time to time. See the figure B, which is retrieved from RBI website, which shows gross NPA ratio of the Indian firms are increasing. As you can see that these are beyond the acceptable threshold of 3 to 4% since 2013 onwards. This recent deterioration in asset quality of Indian banks, especially that of public sector banks, it can be traced to credit boom of 2006 and 2011. You can see this in figure D, when bank lending grew at an average rate of over 20%, and other factors also contributed to the deterioration in asset quality and adverse macro-financial environment, lax credit appraisal and post-sanction monitoring relaxations, project delays, cost overruns, and absence of a strong bankruptcy regime until May 2016. However, as Table 1 shows, there is a positive trend in March 2019 data with a marginal decline in NPAs. As Table 1 shows, there is a positive trend in March 2019 data with a marginal decline in NPAs and slippage ratios with an improvement in the provision coverage ratio. Strong credit appraisal systems, strong monitoring of borrowers, quality of collaterals are important aspects the bank level in minimizing the bad loans. The RBI emphasizes on adherence to loan exposure norms, maintenance for accounting norms, accounting provisions, meeting of expected losses by maintaining provisions, and maintenance of capital adequacy. Of course, the legal framework for recovery of the loans is also important. The foremost initiative of Government of India to address corporate bankruptcy was in 1984 with the enactment of Sikh Industries and Prevention and Rehabilitation Act, which has established the BIFR also. This institutional mechanism suffered multiple weaknesses and was not very effective in recovering the loans. In 1993, as a part of financial sector reforms, government came out with recovery of debt from banks and financial institutions and established debt recovery tribunals. These are special courts for the recovery of bad loans. In 2002, a more powerful mechanism has been introduced. This is called SURFACE Act. These two legal institutions have helped the banks to recover around 40 to 50% of the loans which are secured by assets. And the recent development is even more powerful institutional mechanisms are required to address the recovery of bad loans and restructuring of firms, resolution and liquidation of the firms, which came in 2016 with the introduction of Insolvency and Bankruptcy Code, popularly called as IBC. We believe this to be a game changer in this regard. IBC has some legal litigations, but it is working reasonably in an effective way in resolution of the assets, resolution of liquidation of the stressed assets. Stressed assets are those loans that are not totally NPAs but fairly close to it. In this regard, RBI has also created a resolution framework for stressed assets on June 7, 2019. Apart from the legal mechanism, the other institutional mechanism helpful in credit management are credit rating companies, popularly CRISIL and ICRA. These are helping in banks in rating the borrowers and providing information about financial soundness and risks of the borrowers. Another institutional infrastructure in credit assessment of banks is credit information companies, which provides credit information about individuals and assign ranks to them. Based on their past repayment track record, CIBIL is one of the well-known credit information company. These companies are under the Credit Information Regulation Act 2005. Reserve Bank has also set up a central repository of information on large credits. In 2004, Asset Quality Review in 2015, these are helping the banks in monitoring the troublesome borrowers. The recent development in improving the quality of loan monitoring and management is the establishment of Public Credit Registry. The Public Credit Registry is an extensive database of credit information for all credit products in the country, from point of origination of credit to its termination, repayment, restructuring, default, resolution. So it covers all lender-borrower accounts without a size threshold. With this establishment of PCR information on borrowings from banks, non-banking financial companies, corporate bonds, debentures from the market, external commercial borrowings, foreign currency convertible bonds, masala bonds, intercorporate borrowings, this is a significant institutional development evolving in this country. With full functioning of PCR loan data is available to all the members, it will improve quality of loan monitoring and it may reduce NPAs. Let me conclude. Higher NPAs are a concern not only for banks but also for depositors. The safety of bank deposits is at risk if any bank has substantial NPAs, as it affects recycling of loan funds, profitability, erosion of net worth and capital adequacy of banks, and finally, trust and confidence among depositors. Bank depositors should not keep huge amounts of deposits with banks having higher NPAs. Higher NPAs also due to poor credit management systems of banks and weak corporate governance structure of banks. We definitely need the banks to service our financial needs. We should also be cognizant of the environment in which they are currently operating. I hope this was a useful lesson. Come back to Pi for more.